Good morning, everybody. It is Wednesday, January 752nd, I think. This has been the longest month in the history of months. It is actually January 26th. So hope everybody is doing well. If you're watching this on replay, hello. I'm just going to give people who want to watch live a minute to join. This is currently streaming in my Financial Literacy for Women Business Owners Facebook group. If you want to join that group and you're not in it, go to jamietroll.com/group. We have almost 40,000 women business owners within that group. Lots of great discussions happening in there. I'm also live on my business Facebook page, which is just Jamie Trull. And I am live on my YouTube channel, which is also called Jamie Trull. So wherever you're watching me, make sure to like, subscribe, press whatever buttons are around you, show me some love, and say hello because I can see your comments. So make sure if you're watching me from the Facebook group, make sure to hit the button that gives StreamYard permission to see your name. It should be in the description for this video somewhere. And here is the group. It looks like something's happening right now where none of you are showing your names. So that might mean that StreamYard has reset. So even if you've pressed the button before, you might as well go ahead and press it because literally everybody's showing up as Facebook user for me, which is always fun. And I want to be able to see your smiling faces. So anyway, make sure to hit that when before you leave a comment so that I know who you are. That's just for people who are watching in the Facebook group because of privacy settings, all of that. But I can see you on YouTube as well. Okay, so we're going to get started today. The reason I wanted to bring this up today, okay, the reason that I wanted to, oh, good, Facebook user, it's Braden. Okay, good. So Braden is, this is a good topic because Braden and I have talked about this at length at times about being an S Corp. Here's the link that Crystal on my team just dropped if you want to join. So the reason I want to bring this up now is because the beginning of the year is a really good time to be thinking about whether or not you should change your entity structure. And the reason for that, like you can change it during the year. It gets a little bit tougher. I am an accountant. I love things that are clean, where you can start from the beginning of the year. And the way the rules work, essentially it's easiest if you go ahead and elect it within 2 months and 15 days. So basically by March 15th, assuming you follow a calendar year for your finances, March 15th is kind of the day that you should keep in mind that will make it easiest if you go the route of electing S Corp. You can do it later in the year, but you have to provide a lot more explanation about why you didn't do it at the beginning. And I just think it's easiest to do while we're sitting towards the beginning of the year. I'm so glad. So I think we've seen a lot of questions picking up about S Corps in general. So I'm going to give you some of my thoughts about them and some things to think about and watch out for when you are making this decision. We're not going to go into all the details because this could be, a much longer training. But as far as if you're trying to make this decision, I'm going to kind of weed some of you out to say, don't worry about it yet. And then for those of you who are in the camp of this might be a good idea, I'm going to give you some steps to follow. Okay. So just real quick, let's level set as to what an S Corp is. An S Corp is not a legal structure. So some people call themselves S Corps. That's kind of the vernacular we use. Really, what you probably are is an LLC that elected to be taxed as an S Corp. This is me getting a little bit with semantics, but it's important, right? What you're doing is filing a tax election with the IRS to be treated, to be taxed as an S Corp, but you're still entity-wise probably an LLC. You can also be a C Corp and elect to be taxed as an S Corp. If you're here in my group or if you're watching me, it's more likely you're probably starting kind of at that LLC level and then electing to be an S Corp. If you haven't become an LLC, you will need to do that to be able to then elect to be treated as an S Corp. You can kind of do them at the same time though, if you wanted to, okay? So that's just kind of the level set about what this is. It's a tax election form. It's actually form 2553, who for those who want to go look up and see what the tax election form looks like. There are various different ways to do it. I do recommend talking to an accountant versus doing it yourself because an accountant can not only help you file it, it's not that difficult to file, but can help you, but they can also kind of make sure it's the right decision for you. And then even more importantly, they can help you get it set up the right way because there are a lot of things that are typically or often done incorrectly with an S Corp. Okay. So what the heck is this concept, right? Why does an S Corp exist? What what is the benefit of it? And why do you keep hearing about how it's helping people save taxes? So, on a very high basic level, I want you to think about your business, right? You're probably, if you're listening to this, you probably file with a Schedule C in your taxes, which basically means you just kind of list your revenue and your expenses. It gets filed with your individual taxes, right? And the profit piece of that, right? Revenue minus expenses, the profit piece is what gets transferred kind of to the front page of your personal tax return and is considered taxable income, right? And factored into the calculation. So just the profit piece. Now, that profit piece, when you're filing as a sole proprietor or an LLC, that profit piece is considered essentially earned income, right? So it's similar to if you had gotten a W-2 from a job. That's what that profit piece represents. That means you're going to pay both income taxes, which you can't get around, right? And self-employment taxes. Self-employment taxes are also another name for that is payroll taxes. It's the same thing. It's Social Security and Medicare. So because you're self-employed, you're going to pay both the employer and the employee side of that tax, which is total 15.3%. That's in addition to income taxes. Now, your tax return calculates all together. You probably don't know what's what, right? When you're looking at it, you're just thinking about your total taxes due. But ultimately, there's those different pieces that are a part of what you are filing, okay? So that's something to keep in mind. And all of that income, all of that profit, right, is assessed all of those taxes. How does an S Corp help you? Well, an S Corp allows you essentially to take that profit and pull it into two buckets, right? To pull it into two buckets. One of those buckets, which is taxed lower than the other. So that's where you can get tax savings from being an S Corp. So if you take that profit number, right? So think about what that profit number is in your head. If you could divide that out and say, okay, a portion of that is essentially my earned income for working in my business, right? It's the work that I do. It's for being an employee in my business. Now, if you don't work in your business and you basically are just an investor, then that's one way that you wouldn't have to pay that. But most people, most small businesses are actively working in your business. If you're not, you're probably not here watching me because you're sitting on a beach somewhere in Jamaica, letting somebody else run the business for you. But most of you are probably deep into it with your business. And therefore, you would still have kind of a paycheck portion, right? So you essentially become an employee of your business as an S Corp. And you're paid a paycheck, right? And that paycheck has all of those same taxes associated with it. So your salary portion that you take out is going to have income tax, and it's also going to have all those same self-employment taxes. They're called payroll taxes in that instance. And you're still going to pay both sides because you're still the employer and now you're the employee. So you're still going to pay that full 15.3% on the salary portion. But, and here's where the magic comes in, right? When you're talking about S Corps. If you make above and beyond what's considered a reasonable salary, and we're not going to get into a lot about reasonable salary here and how to pick it. That's something I do recommend that you go and talk to an accountant about, or there are companies that do this for you that can do like a reasonable salary report, right? But if you have profit above and beyond that, so let's say you make $100,000 and you say, you go through this with your accountant and decide that $60,000 is a reasonable salary. I'm not saying it is or isn't. I don't know your business, but let's say that that's what you decided. That means that extra $40,000 of profit is essentially considered, it's not earned income as an employee to you, right? It's sort of like the profit that you're making from being an investor in your business. That's not exactly what it is. It's not like the technical way to put it, but essentially that's how I see it, right? You're paid money for being an employee in your business, and then you're also paid money for essentially being an investor in your business, being kind of the owner, right? Like that's your owner. And that amount you can take out in owner draws, right? That amount then is going to be taxed at a lower rate, okay? So in that case, that amount, you're not going to have those self-employment / payroll taxes assessed on that. You're still going to have to pay income tax on it, right? Based on your brackets and where you fall and all that. But that extra 15.3%, you don't have to pay on that portion of income. That is where the benefit comes in with an S Corp. Okay, so that's the general, hopefully that's helpful. Let me know if that makes sense, but you're basically just able to pull that income apart. Instead of paying all the taxes on the full profit, you can kind of pull it into two different buckets. That's sort of the way that I envision it in my head. Bucket one, you have the full taxes on, and then bucket two, you don't. Now, of course, you have to have enough right? You have to be making enough that you have amounts above and beyond what's considered that reasonable salary to be able to get the benefits of an S Corp. So that's why if you're in total making $30,000 in your business, it's going to be pretty difficult to tell the IRS, well, $15,000 of that is my salary and $15,000 of that is my additional kind of owner draw. Especially if you're the only person working your business, they're going to say, I don't know about that. I'm not sure you could pay somebody else in the marketplace $15,000 to do what you do, right? So that is where the higher you have profit, and this isn't revenue discussion, this is a profit level, right? The higher your profit is, the more likely it may start to make sense to be an S Corp because you're going to have more of that income to be able to put in bucket 2, right? So that's really what we're looking for is how much income can you put in that bucket 2? That's what you're saving money on. If you don't have enough to put in bucket 2, probably doesn't make sense. So where exactly does the line come? And people love rules of thumb. I know y'all love them. I know you want me to give you one. I'm going to, but then I'm going to caveat it 6 ways to Sunday. Okay. And you will hear different accountants. This is also what's confusing for people, that different accountants are going to have different rules of thumb on this. That makes sense, right? They don't teach you like, hey, accountant, here's the rule of thumb when you go through, when you're getting your CPA. What they teach you is all of the 15 million different rules and calculations that go into it. So we love to say it depends, but truth be told, you guys want to hear a rule. So what I have always said is somewhere you need to start having the discussion. That's what I'm not going to give you a rule of when you need to become an S Corp. I want to give you a rule of when you need to start having that discussion with an accountant. Okay. Now, if you reliably are generating between, call it 70 to 80,000 at least or more. Okay. That's my rule of thumb. That's Jamie Trell's rule of thumb. That is not the greater CPA rule of thumb. Okay. But 70 to 80,000, that's when I want you to sit down and start talking about it with your accountant. Likely before that point, it's probably going to be a no, or kind of like, right on the line there where the administrative costs and all the kind of hullabaloo that goes with being an S Corp probably will outweigh any savings that you might get, right? But when you get into that space, then you need to be kind of thinking about it. And maybe when you're kind of even over that 100,000, 100,000 to 200,000, that's a good time to really be thinking about it. Again, that's profit, not revenue. So if you're making $100,000 in revenue, but you're only taking home $30,000 in profit, not a good time to talk about S Corp. All right, so you want to get that profit number reliably over that $70,000 to $80,000, then you can start to talk about it. It is highly dependent on your situation, though, and that's why I never recommend anybody do this on their own. You want to talk to somebody. And the big thing I want to tell you is to make sure that you ask the right questions, because there are accountants who are going by kind of old guidelines and are making recommendations that aren't individualized. And that's when you sit down with an accountant, if they tell you, yes, you should be an S Corp, and the only thing that you have told them about your business is your profit, I would find somebody else or say, hey, I want to go a little bit deeper and actually really run the numbers, right? We're accountants. You want to make sure somebody has actually sat and run the numbers for you based on your situation, because it really can vary what makes sense. And one of the things that I have seen time and time again is people being told that S Corp is the best status for them, and then not also, so they'll do it, but then they also don't understand what they need to do on the back end of it, right? And the additional requirements that come with being an S Corp. And sometimes those people that say, I saved boatloads of money, they're like, I saved so much money by being an S Corp. Usually I kind of stop them and I'm saying, okay, all right, like show me. And they usually don't have anything necessarily to show me. And that's one of the things I think that I'm like, I got to see the numbers, because in my experience, S Corp is not going to ever save you $50,000. S Corp, if you feel like you're saving an insane amount of money, either you maybe don't understand necessarily like how it's working, or you're not doing it right, which is kind of the fear that I have for people. So one of the things that happened when we had the whole pandemic, right? Let's flash back to 2020. I know we don't want to. I don't want to either, but let's flash back to 2020. And everybody was trying to get PPP loans. And before they changed the rules, right, for people who were S Corps and things like that, well, that actually never really changed. But so with S Corps, there was a problem for a lot of business owners that ran S Corps that weren't paying themselves via salary. Okay. They were not paying themselves via salary. They were not on their own payroll. They were not withholding taxes for themselves. They were not issuing themselves a W-2 of any kind, right? They were taking all of their money out of bucket two. And the IRS does not like that. Again, unless you are not working your business at all, that's going to be pretty hard to defend, that all of your money is basically investment money and you don't have to pay yourself anything as an employee. You'll save the most taxes that way, right? But that's not being in compliance with the rules of being an S Corp. All right. So oftentimes when people tell me like, hey, I'm saving all this money, I'm like, are you paying yourself a reasonable salary though? Because yeah, you can save a lot of money by taking everything out of your business and owner draws. But if you're ever audited, you're in trouble, right? Like that's not how it's actually supposed to work. So that's what happened to a lot of people in the pandemic, where they're like, I'm an S Corp, but they're not giving me a loan because I didn't pay myself, but I have profit. So why can't I get this, this payroll loan? Remember, Paycheck Protection Program was for payroll. And the IRS was saying, well, you don't have any payroll. You don't pay yourself on payroll, So it's kind of this like, you're not paying payroll taxes. So that's sort of the way it was looked at, is if you're not paying payroll taxes on it, it's not payroll. You can't get a Paycheck Protection Program. You can't have your cake and eat it too. And that caused a massive tizzy among people who were S Corps and maybe either paying themselves a really low reasonable salary or none at all. Okay. So, and that's where they got kind of hit and they were upset about it. And us accountants who were like, you're supposed to pay yourself a reasonable salary though. There was a little bit of like, told you so, not in a good way, not in any kind of like way that was satisfying, but in a, yeah, like that's how this works. So that's why it's super duper important to be paying yourself that reasonable salary. If you do feel like you are an S Corp and you're saving all this money, I want to see the numbers, right? Because part of it also is some people believe they're saving a lot of money because they don't have as much to pay at the end of the year. And that often happens when you're an S Corp, your salary portion, now they're withholding taxes. So you're withholding your taxes throughout the year, just like you would as a employee, right? So yes, you may have less of a check to write at the end of the year, but that doesn't mean you paid any less in taxes or as much less in taxes as you think. You just paid it over the year and didn't realize it. Well, which is always what I recommend anyway, when you're paying taxes, to make sure that you're setting it aside, even if whether you're paying estimated taxes or not, that you're setting it aside so that it's kind of out of sight, out of mind. But a lot of people feel like because they're not paying as big of a check at the end of the year, because a lot of that was already taken out of their paycheck, that they're saving a lot of money in taxes. And when you actually sit down and work it out, it's not as much as you think. So I'm not dogging S Corp. I'm not going to totally dog S Corp. I think that there are specific situations where it can be very beneficial. Okay. But just don't buy into the hype is what I want to make sure that I tell you, because I think that so many business owners believe that there is like a silver bullet and they're missing out on it. And if they, did this one thing, it's going to make all the difference. And in general, that's not really it. So I'm going to tell you the last thing I kind of want to tell you, and then I'm going to show you a form if you want to play around with it. It's really kind of meant more for accountants, but I know some people like to play around with some numbers on their own. So just to kind of illustrate a few things, I'm going to show you something that I have for this. But the last thing I want to tell you is when you do go talk to an accountant about this, okay? Number one, you want them to run the actual numbers. And the things I want you to ask them are this, all right? The things I want when they're giving you a recommendation, I want you to ask them, does this include additional, or are you considering additional administrative costs, right? When you are making this recommendation, does this include that? Because it is going to be more costly to be an S Corp the right way, meaning you're going to have to start running payroll for yourself, right? It's probably a payroll provider that you're going to use. You are probably going to, you're definitely going to have another tax filing, which is going to cost a little bit more, right? And that tax filing, there's more that comes with that. Like you're going to need to, if you don't really keep much of a balance sheet, you're going to need to make sure that you're keeping a balance sheet. There's more requirements along the way as an S Corp. It may impact the amount you're able to give to retirement as well. That's another question. Does this take into account the amount I'm planning to put into to my retirement accounts? Because that can make a difference on whether it makes sense to be an S Corp or how useful it is to be an S Corp. Because your entity type dictates essentially kind of the caps of what you can put into your retirement accounts as well. So if you're doing a lot of that and you're maxing out your retirement accounts, then that's something to make sure to bring up. Okay, I want you to talk about that. And then I want you to ask them, and they're gonna probably do a double take that you even asked this question, but I'm gonna give it to you anyway because it's an important one. I want you to ask them if they're considering the impact of the QBI deduction. You don't have to know what it means. They should know what it means. And if they don't know what that means, that's a red flag, okay? You want to ask them if it's including the impact of the QBI deduction. What the QBI deduction is the Qualified Business Income Deduction. It was part of the Tax Cuts and Jobs Act of 2018. And so a lot of accountants who are still in the pre-2018 rule of thumb, it was a little bit easier to kind of figure out, like, to have a rule of thumb before 2018. QBI makes it a lot harder. It makes it even more important to sit down and run the actual numbers than just to use a rule of thumb. Okay. So that's where I want you to ask them, does this include the impact of the QBI deduction for my business? That's gonna tell you a lot about that accountant, how they respond to that answer. Okay. And the answer should be, yes, it does. And there may even, in some instances, be state tax consequences to consider. That's less likely, but it does happen. It does happen. So I want you to kind of ask those questions to make sure that at the end of the day, that it is the right thing for you. Because again, it is additional compliance, not so much that it's, crazy or anything like that. Once you get set up the right way, you should be fine. But you want to make sure you go in eyes wide open. Okay. Now, real quick, if you want to know more about S Corps, if you want to know all the requirements of S Corps, go even deeper into some of this, have the whole S Corp checklist. It is a bonus module. I have a whole bonus module for it in my Financial Fitness Basics program. So that's my self-study fundamentals program about all the things you need to know as a business owner about accounting, finance, and taxes. We go over what's a P&L, what's a balance sheet, what are the different entity types. We go over all the different types of taxes you have to pay and how to pay them, right? So it's kind of our basics fundamental course. You can do it all in one day if you want to. You get the full course when you sign up, and we have that bonus module included. And right now, if you buy it in the next 5 days, by the end of January, this will be expiring after the end of January, we are going to give you another bonus as well, our ultimate Getting Ready for Taxes bundle, which includes additional bonus lessons on how to get ready for taxes quickly. If you feel like you're totally in a mess and you're like, how am I going to do this? Right? You're gonna want to do that. It's going to give you a checklist of all the things that you need to make sure that you do so that you don't miss anything. We've got plug and play templates in there to help you maximize your deductions as well. There's lots of fun things in there. And again, that's something you can get through really quickly. It's $149 is our normal price for that, but we're throwing it in free if you buy Financial Fitness Basics within the next couple of days while you're in January, because in January is when we need to be really focused on, okay, what do we need to do to make a plan for taxes? We've got deadlines already coming up. The end of January is 1099s are due, right? We talk all about that within the bundle as well to make sure that you get out the 1099s that you need to send. So go check it out, jamietrell.com/basics. Okay. All right. So the last thing that I wanted to do was give you guys a tool as well. Okay. Give you guys a tool for looking at this yourself. And I will again tell you, this is a tool meant for accountants. So ignore some of the accountant speak. I'm going to tell you the lines that actually matter. If you want to just model this out a little bit for yourself, I'm going to tell you how to do that. So I have dropped a link. This is the link. Hopefully that's showing up. I don't know if it's showing up in the Facebook group. So Crystal, if you want to copy that link and put it into the feed for the Facebook group, it should be showing up on YouTube. So you can go grab it. But this is done by Intuit, who's the maker of QuickBooks and TurboTax and all of those things. And I found it really helpful. I run this thing way too much, you guys. I run this thing all the time looking at entity structures for myself and for other people. So hopefully, okay, so this is what it should look like when you go to this screen. I'm just going to tell you a couple of the ones that you want to look at. Now, again, this is where we're talking about QBI, okay? I would, for most of you, the answers are probably yes. Again, you can talk to an accountant and see if they really are and read the description, go to the IRS guidelines it gives you if you really want to. Most of you are probably yes, okay? Most of you are probably yes. Now, if you come down here, you're going to put in business activity income before wages. So that is before you pay out any wages at all, right? What would your income be? So again, this is before wages. So this is kind of your profit. That's when we're talking about income, that's profit, but that's profit before paying out wages. So add that back in. So let's say you made $100,000 and you're the only one who works in your business, okay? So you made $100,000 in profit and you're trying to figure out, right, would I be better as an S Corp? So we're going to put 0 here because we're right now assuming there are no other employees in the business. And then what this is talking about is what would your reasonable salary be? This taxpayer W-2 wages from business activity. If you became an S Corp, what would you pay yourself in reasonable salary? Again, you can play around with this. There are reports and things like that that you can get run. Your accountant can help you with this. For right now, I'm just going to put $60,000. Let's say if you felt like you had to go hire somebody to work in the business for you, you would pay them $60,000. That may be completely off from what you actually think, but we're going to put that down for now. We're going to ignore these next three because they're too technical. And we're going to come down here. You're going to pick your filing status, right? Single or married, filing jointly. Let's say you have a spouse. Let's say your spouse, or maybe you have another job, right? Let's say they make $75,000. That is their other income. We're going to put that in there. And then in here, you can put in different things. Right now, we're going to put nothing in here. But if you have, if you're wanting to make contributions to retirement plans, right, you would put those amounts in here. Now, we're also going to assume that you take the itemized deduction and that that you take the standard deduction, that you're not itemizing. Again, if you do itemize, you can put that number in, but let's just for ease, we're going to do this really quickly. So you'll see I've only put in 3 different things within here, but that can give you a lot of information. So when you come down here, you can ignore all of this. Okay. You can ignore literally all of this, but this is where we get into, you see the QBI deduction, how different it is. So these are basically the different entity types. So the only columns I want you to look at are this one. This is Schedule C. This is if you were a sole proprietor or an LLC. So that's this first column. You would file a Schedule C. Then I want you to come over here to this S Corp K1. If you were an S Corp, all right, you're going to see an amount in this column. So just remember, it's the first column and the second to last column. Okay. If we come down here, I want you to look at total taxes. So if you were an LLC, you would pay total taxes of $33,585 in this instance. If you were an S Corp, you would pay $32,519 in this case. So you can see, okay, it saves you $1,000. Saves you $1,000 to be an S Corp. However, right, remember I said there are administrative fees, things like that, extra tax filings, payroll. If I were advising someone on this, I would probably say not worth it right now. Not worth it right now. Now, small tweaks could make that change, but right now I'd say, not worth it. Now you can see though, let's tweak something here. Let's say you could defend a $50,000 reasonable salary. Let's say you felt like that was defensible. Again, I'm not saying it is or isn't. I'm just putting that in here. All of a sudden, now you're still paying that $33,585 as an LLC, but as an S Corp, because we've put an extra $10,000 in that less taxed bucket, okay? If we go back to what we were talking about in the beginning, now you're saving about $3,000. At that point, I'd be like, okay, let's talk, right? Like, let's talk about this. Let's see if this is something we want to do. So you can see how small adjustments, but then let's say you're like, you know what, I want to put, and we have to be mindful of limits here, but let's say that's probably a lot. Let's go with 15,000. Now I'm not paying attention to limits. I have not done the math on whether you could even do that. But let's say you wanted to put that into a SEP IRA that you have for yourself. That can also make a big difference. So now we come down here and look at this, $30,945 versus $30,549. So we're talking about a couple $100 of savings here. So you can see how little tweaks can make a big difference. And this is why it's so important not to set a specific, rule of thumb that is for every situation, because there are some things that actually really impact the calculation that are specific to you. So you can go grab that again. I didn't create this calculator. This was done by Intuit. I trust them. I think, again, like just putting in a couple of numbers for those things can give you a lot of insight. I still would not make the decision on your own. If this is leading you down the path of S Corp, go talk to an accountant. I have a great list of preferred vendors. We could post that too. That can sit down and talk to you about this and decide if it's the right thing. And they can also help you actually make that election. So that would be kind of what I would recommend. Now I'm going to go back because I see a question here. Can I buy the tax info bundle separately if I've already bought the Financial Fitness Basics course? Yes. So we have a special deal. If you already own Financial Fitness Basics, okay, we have a special deal for you. You should have gotten an email about it, or a few emails probably over the last couple of weeks about this special offer. Email us at support@balancecfo.com if you haven't or if you can't find it, okay? Because we'll give you access to that special offer that's just for people that already own Financial Fitness Basics. Importantly, remember I have 2 courses. Financial Fitness Basics is a self-study, 3-module, quick, like fundamentals course. Financial Fitness Formula is the one that is, there's a big live component that's strategic. It's all about becoming your own CFO. So I know sometimes that gets confusing as to what you bought. Financial Fitness Basics or Financial Fitness Formula. But if you already own Financial Fitness Basics, yes, we have a special deal for you. Here's our preferred vendors list. For those of you who want to sit down with an accountant, jamietrell.com/preferred vendors is where you're going to, preferred dash vendors is where you're going to want to go to find some awesome, we have accountants, we have bookkeepers, we have financial planners, we have virtual CFOs, basically whatever your needs are. We've got some amazing financial, they're all women, they're all vetted by me. And I vouch for all of them. So we don't do any services in-house currently. That is something that I just partner with amazing other businesses to help support their businesses. Let's see. Good. I'm glad. I hope you're enjoying our preferred vendor. I'd love to know who it is. And if you do use a preferred vendor, we do have a way. If you go to that same website, we have a place where you can turn in feedback. So we love getting feedback forms, positive or hopefully not negative, but we want to know if you've had a bad experience because we do keep tabs on that and we do make changes if we need to. So share your experience if you've used a preferred vendor of ours. We really love that. We also, especially with the positive ones, we love to share them with them and, brighten their day. So jamietrell.com/preferred-vendors. And again, if you want more details about any of our offers, or if you have questions about Financial Fitness Basics, right, email us support@balancecfo.com for all the details. So that's all I have today. Again, that's tip of the iceberg when it comes to S Corps, but I wanted to give you those marching orders, some places to start. If you're thinking about it, again, March 15th is really going to be, if you want to elect it by then, that's going to be the best timeframe to get that form in, to use that form 2553 and elect to be treated as an S Corp. So, I would say it's time to be making that decision. And the earlier you make that decision, the easier it is because you can institute a new payroll system earlier in the year and kind of get all of that done with. So I do recommend going forward and making a decision, or maybe you decide, we're going to wait. We're not quite there yet. Let's think about this again next year. Okay. So I do recommend at the beginning of every year, making sure that you are the right entity type. And thank you, Heather. I appreciate that. So random note, I am on the Forbes Council now, the Forbes Business Council, which is super exciting. So I get to write for Forbes. I just had my first, it's a small byline contribution that got published yesterday. So that was pretty exciting. I'm writing my own full articles here pretty soon when I get a few seconds to spare, because I feel like there are a million things happening all the time. So I need to actually sit down and write it so that I can publish it, so that I can send it out to you. But it's been very exciting. Okay, hopefully this was helpful. It sounds like Deidre, it was helpful. Good. I'm glad. So that's what I want to give you is the basic information, and then you can take it farther if it sounds like the right step for you. All right, y'all, you are amazing. I will talk to you. I think I'm gone next week, but I will be back more regularly in about mid-February or so. And I'll talk to you guys soon. Bye for now.